oil market volatility, what it means for Nigeria and the banking sector. Tensions between the United States, Israel, and Iran continue to escalate, sending shockwaves through the global energy market, with significant implications for oil-dependent economies like Nigeria. Good day, everyone. Welcome to Keynomics. My name is Adebanke Adeshida. Today, I'll be talking about the growing geopolitical crisis in the Middle East, its impact on global oil markets, and what it means for Nigeria's economy and the banking sector. At first glance, this may seem like a conflict happening thousands of miles away. But for Nigeria, the impact is much closer to home. At the center of the disruption is the Strait of Hormuz, one of the world's most important oil transit routes, responsible for moving nearly 20% of the oil supply globally. So when tensions rise there, the entire global energy market feels it, and that is exactly what we are seeing today. So what is the global impact? The ongoing tensions have triggered major supply concerns across global markets. Recent disruptions around the Strait of Hormuz have reduced oil flows and pushed Brent crude prices above $100 per barrel, raising fears of tighter supply and rising inflation across major economies. Countries heavily dependent on Middle Eastern oil, including China, India, and Japan, are the most exposed. But this goes beyond crude oil alone. The region also plays a critical role in the movement of refined fuels, petrochemicals, fertilizer, and industrial materials that support manufacturing, transportation, and agriculture globally. So even if tensions ease, supply chains may take time to fully recover due to shipping delays, higher insurance costs, and increased security checks. So what does this mean for Nigeria? For Nigeria, this situation presents both opportunity and risks. Higher oil prices could improve export earnings, boost foreign exchange inflows, and support government revenues. With oil prices trading well above Nigeria's 2026 budget benchmark, which is $64.85 per barrel, there is potential for stronger fiscal earnings in the short term. However, this upside is not as straightforward as it appears. Nigeria is still producing below its oil production targets, while a significant portion of future crude revenues remain tied to existing loan obligations and forward sale agreements. This means that even with higher oil prices, fiscal pressures remains elevated and borrowing needs continues to rise. There is also increasing pressure on the domestic economy. Since the removal of fuel subsidies, global oil price increase now feeds directly into local fuel prices, and this results in higher transportation costs, rising food prices, and increased operating expenses for both businesses and households. After several months of slowing inflation, Nigeria recorded another uptick in March 2026, an indication that the global energy shocks are beginning to pass through the domestic economy once again. This creates additional pressure on consumers, businesses, and overall the economic growth. What is the implication for the banking sector? For the bank, the current environment presents a mixed outlook. Stronger oil revenues and higher FAC allocations could improve liquidity levels in the financial system and support transaction volumes. But on the other hand, rising inflation and operating costs increase credit risk across key sectors of the economy. Industries such as manufacturing, logistics, and consumer goods are already facing margin pressure due to higher fuel and energy costs, which may weaken their ability to service existing loans. There are also growing foreign exchange and interest rate risks. If inflation continues to rise, the central bank may be forced to tighten monetary policy again, which will lead to higher borrowing costs and slower private sector credit growth. In addition, banks are still adjusting to the withdrawal of regulatory forbearance, which already pushed non-performing loans from 4.9% in 2024 to 7% in 2025. As a result, financial institutions will need to be more cautious and risk sensitive in their lending decisions. What are the key points to watch out for? Going forward, investors, businesses, and financial institutions should watch these key indicators closely: Nigeria's oil production levels, inflation trends and domestic fuel prices, central bank policy decisions, and global oil supply conditions. In conclusion, ultimately, the crisis in the Middle East is more than just a geopolitical headline. It is a direct test of Nigeria's economic resilience and the banking sector's ability to manage uncertainty. While higher oil prices may create short-term revenue opportunities, the broader risks from inflation, debt pressures, and global market volatility remain significant. For banks and businesses alike, success in this environment will depend not just on predicting oil prices, but on building resilience in the face of continued uncertainty. Moving forward, Keystone Bank strategy must focus on resilience by staying ahead of price swing, supporting clients through hedging and advisory services, and remaining vigilant about the inflationary pressures these shocks bring. I hope this episode of Keynomics has given you valuable insight into how global events continue to shape Nigeria's economy and the banking sector.